Greetings, friends, and welcome to the special edition of the Financial Game. As always, Jose Miguel Crespi and Ferdinand Roño are here to bring you information, especially in this episode, which is now more focused on the alternative world, mainly highlighting areas outside of traditional markets, with a strong emphasis, of course, on our real estate and new housing construction. Welcome, Jose Miguel.
Ferdinand, once again, in the context of sharing information, we're coming from a very interesting episode. For those who haven't listened to it, I invite you to check out the previous episode. It works very well as a preview of what we're going to talk about today. But basically, we just talked a bit about the markets, where we are, what we're looking at in the short and medium term going forward. The Federal Reserve is expected to lower rates in the next two Federal Reserve meetings, according to what the Fed Funds Futures market indicates. We're looking at best, maybe half a point lower. This should be positive. Ferdinand, let's talk a little about that. The real estate market is coming along. However, not as strongly as I think people expect. People expect there to be a pretty direct correlation, but there really isn't. We can talk a bit about this. Also, the fact that we've mentioned how we've come from such a significant bull run, we've come from a stock market that's been running strong, and how history, especially in 1999 to 2000, shows us that once that marathon the market is running starts to tire out, a new bull market can be born, but in this case, in real estate. Ferdinand, what does history teach us about this? Back then, which not many people know, when the so-called dot-com bubble burst in 2000, where did the money go?
Well, Jose Miguel, mainly if I look back at that history from 25 years ago, and in fact there's a cycle called a major 25-year cycle, so there's no coincidence here, there's causality. There is a 25-year economic cycle in the stock market. What that cycle says is that there should be a strong bull run and then a situation of a severe correction leading us to a possible recession. I repeat, this is like looking into a crystal ball. This is simply using it like any other cycle. The past expresses itself in a different way, but more or less the consequences and the symptoms are the same. The script says that by 2026, at some point, some kind of recession event should occur. That recession event will create some kind of correction, similar to what happened between March and October of the year 2000. The internet bubble bursts and the economy starts to weaken. The Fed starts raising rates because at that time the economy was overheated. And so at that moment, because the stock market starts to deliver subpar returns, people begin to look for ways to shift their money, which at that time, alternative investments didn't exist. Let me correct myself. They did exist, but were only available to those industries, those endowments. Now I'm going back to the endowment approach. Now I'm going to tie all the topics together into a single thesis. Those private alternative investments were only available to institutions, not to the retail world. Now there are indeed alternatives available for the retail world. Therefore, I hope that the bubble won't be as violent and that the shift of money won't be as drastic towards those areas of real estate. But that caused a bubble in the real estate world, which burst in 2008 because people started rotating money out of areas that weren't generating returns. They were practically collapsing due to the rise in interest rates. The stock market was deflating because of overvaluation or a bubble. And so the only area of prosperity at that time was to pour money into real estate, mainly income-generating properties specifically. That eventually caused the recession. When the recession hits, what happens? Interest rates start to drop specifically. And that caused the housing market, with a push from the George W. Bush administration, trying to make it so every American could have access to their first home, led Fannie Mae and Ginnie Mae to artificially create financing facilities, which created a bubble in the mortgage real estate market, the consequences of which we already saw in 2008.
But to be
free, well,
7 years, 8 years of growth and increases in value and returns in real estate portfolios or in the direct acquisition of properties. So I repeat, this is again forecasting, it's studying history and seeing what could or could not happen and drawing some kind of
anticipation. And I'm speculating for myself. From the years I've spent following Larry, I think this year, he himself has said it in several articles he sent me, that this year has been one of the most difficult years he's seen for forecasting because of all the forces in 2026. He
mentioned it in his latest report.
Very difficult because honestly, I think he's not going to say it now, but I think Larry is paying more attention to an advanced case scenario, even though he's someone who has typically been quite bullish on the market, but that's why all these situations are happening. And even in the 2025 forecast, I made a caveat that if the market didn't turn around in March or April, we would have a situation. There would be a backup scenario, a bearish case scenario. But we're anticipating something that hasn't happened yet, right? No, of course. So far, it hasn't been.
Excellent. In terms of market data, we should keep in mind that we've seen a bit of rotation, a bit of volatility, but historically and typically, the years tend to end strong in value markets. Now then, we had the first rate cut from the Federal Reserve. One or two more are expected before the year is over. How could this be reflected in mortgage rates? What's happening in that regard with mortgage rates? And what phenomenon have you observed? With this first rate cut we had from the Fed in terms of inventory movement in the market, where does this stem from?
Well, the real estate market has been very interesting. We have been and continue to be consistent, and in fact we're going to hold the seminar we did in English but this time in Spanish for our people by popular demand. There were people who didn't follow it and couldn't understand all the content, and it's vital. Part of the content I'm about to share with you now is part of the answer. There's no doubt that mortgage rates have come down a bit, but I don't want my people to fall asleep thinking we're going back to 4% or 4.5% mortgages. I don't see it happening. I just don't see it in general. The United States is running a significant deficit. For now, the long end of the curve, which is quite similar, has quite a bit. In relation to the mortgage market, has been sticky. Sticky means that it's not going to drop as much as the Federal Reserve is going to lower rates. That's how I see it. Now, are we going to get a little help? Yes. And we're already seeing it in applications, refinancing requests, and mortgage applications. There was a surge, more than a 25 to 30% increase. Sales have gone up. Affordability has improved. Not to a level where you'd say, wow, it's a buyer's market now turned into a seller's market. No. The market is balanced. For example, people tell me that you have to charge. No, I've read articles saying that you have to charge. No, look, the market where you have to charge is actually a pretty balanced market. We had a dip where absorption dropped from rose to 7. That's not a recessionary market, but one in correction. We're already seeing numbers at 6 in some areas of the Southwest, 5.75. So the market between sellers and buyers is pretty balanced, but still tilting toward the buyer. But that will change if rates drop a little because demand will increase, and now the high season is coming. High season for us is from October 30th to May 1st because that's when many of the snowbirds come and a lot of people fall in love with the place and want to buy. And we haven't had, luckily, knock on wood, any hurricanes this year. So the memory is improving a bit from the disasters we've had in recent years. New construction is the playbook right now. An article came out recently that we're going to send out now in the coming days. In fact, I'll take this opportunity to mention that we're going to have monthly communications for our sales team. We'll have at least one article like the one we're about to send, and we'll have content. This very podcast, we'll share the link so people can stay up to date every month with the latest information. But new construction is the name of the game. Whether it's build to rent, which is the strongest right now, or build to sell. But what we mentioned at the beginning of the year in the first quarter, and what we said was extremely important in the English seminar, was confirmed in this article that came out last week on Realtor.com. It's called Why New Construction Could Be the Best and Smartest Choice. The smartest move in the current status of the real estate market. And that's exactly what we've been saying all year long.
And what can that be attributed to? What are the factors behind why new construction is preferable? Cost?
Insurance?
Insurance?
Cost? Is new construction more solid because of global warming? More efficient layouts, homes that are less hot, with better content and features that are more in line with people's preferences. For example, if you have a house right now, which is from the resale market of 2015 to 2018, if you look at the features of those 2018 houses compared to the ones now, the current ones are much more efficient, even though you have a higher cost of ownership, but they are much more desirable. And so that house, that market has not dropped enough to compensate for an incentive because they're pricing the houses that are already in that resale market almost the same as new construction. And if you have a new construction where insurance rates are going to be lower because you have impact windows, the insurance company isn't going to quote you for a 10-year-old roof that they'll ask you to replace versus a brand new roof. For now, the builder's warranties are going to cover things, so for an investor, the cap rate will be better and you'll have a more desirable product. That's why the situation is the way it is overall. It's because there's been an effect where housing prices in general overall haven't gone down. They've actually gone up 1.2% despite all of this. Yes, areas like Texas, Austin, territories that increased dramatically after COVID or during the COVID era. Well, there you had a huge increase, and now the market is settling back down, but it's still way above where it was at pre-COVID levels. So the overall resale market has remained quite stable, very resilient. So when you have a house, at least here in Florida, with insurance expenses, property insurance, and in terms of replacement cost, the cost to replace or upgrade, it actually works out better with a new property that already comes with the builder's warranties for the next 5 years and offers better efficiency. That's why new construction right now here in Florida makes more sense than in other parts of the country. But there's no doubt about it, there has been a huge shift, a massive change, Jose, in the real estate market. Right now, the states that didn't use to see much growth are now the best markets. Connecticut, Massachusetts, Vermont, Maine, Ohio. And part of the reason is that many of the factories that are building new manufacturing facilities now need cheaper land, and they're mostly concentrated in the Midwest and Northeast. And so that has caused, yeah, man, I wouldn't move to Buffalo with all due respect because for my taste, it's just too cold. But there are people who say, well, I'll move to Buffalo because there are good opportunities and it's much more affordable instead of Florida, which is much less affordable. So I would say it's a balanced market, but new construction makes a lot of sense.
In Florida, there's the possibility that we don't have to close. There's the possibility of adjustments to property taxes, which is good news for
The
market, and in real estate, this is being discussed at the political level here.
The ongoing debate is that everyone here in the legislature wants lower property taxes. It's politically appealing and will bring a lot to the state. And if a dummy wins in New York, then we have to prepare for a significant capital flight, some of which will come to the southeast again. We don't know that yet. The elections are on November 4th, and
Obviously see how it will be subsidized. So adjustments, the other race is currency.
that's indeed the biggest and most significant situation. And where there are a great many cross currents that are actively at play, if we were to do that, then where exactly are we going to acquire the necessary funds and financial resources to adequately replace it and diligently maintain our essential infrastructure, our vital education systems, and so forth and so on, etc., etc.
So we're going to keep that. It's going to be a hot topic for the next few months. I think in this episode, we're going to go into this quite a bit. Following this, the tracking the news. DeSantis is in favor
Of the project,
Yes, and what he says is he brings a national comparison regarding sales tax. He says we can raise the sales tax a little. For a Puerto Rican, the left will say, well, of course, go ahead and raise the sales tax since they're already used to sales tax in Puerto Rico, right? But it does reduce what is property tax. So that's one of the possible avenues, an increase in sales tax to somewhat offset the loss from lowering property tax. But we have to see how that progresses, and that's what this episode of Juego Financiero is for. So, Felina, thanks again, and to all our audience, we hope to keep counting on your support. See you next time.